238.3 billion. That's how much was invested in global funds at the beginning of 2026, according to UK fund data, which makes global the largest sector by far, much bigger even than UK funds. So why are so many people looking beyond the UK when it comes to investing? Well, there are a lot of interesting things at play here. And that's the topic of today's video. Hello, I'm Brian, and I'm here with Moneyfarm to walk you through global investing, why it's become so popular, whether it makes sense for you, and if you decide it does, how you actually go about doing it. So let's dive in. Now here's something that might surprise you. The UK stock market, despite being one of the oldest and most respected in the world, represents only around 4% of the total global stock market. The US alone accounts for roughly 60%. So if you only invest in UK companies, you're effectively ignoring 96% of the world's investment opportunities. And that matters because some of the most powerful engines of economic growth over the past few decades haven't been in the UK. They've been in the US, in Asia, in emerging markets across South America and beyond. Companies like Apple, Microsoft, Samsung, and TSMC, these are businesses that have generated enormous wealth for their investors, and none of them is listed on the London Stock Exchange. Now, that's not to say that UK investing is bad. There are plenty of strong, well-established companies here, and a healthy UK allocation makes sense for most investors. But if your entire portfolio is focused on the UK, well, you're working with a very small slice of a very large pie. This is the core case for global investing. Not that it's exciting or fashionable, but it simply reflects the reality of where growth happens. And speaking of where growth happens, let's take a closer look at what the world actually has to offer. Different parts of the world grow at different speeds and in different ways. Take the US. It's home to some of the most dominant companies in human history, the big tech giants, the ones powering cloud computing, artificial intelligence, digital advertising, or e-commerce. They're mostly American, and over the past decade, that's translated into significant returns for investors with exposure to US markets. Then there's Asia. Japan has long been a global leader in robotics and precision manufacturing. Taiwan is the heart of the global semiconductor industry. The chips that power everything from your phone to your car are largely made there. And in South Korea and China, you have some of the world's most dynamic consumer technology and digital platforms. And then there are the emerging markets, countries across parts of Asia, South America, and Africa, where rapidly growing middle classes are driving demand for goods and services that established economies take for granted. Things like banking, insurance, smartphones, or cars. That kind of consumer growth can translate into a significant investment opportunity, though it does come with a higher risk, which we'll come back to in a moment. The point is this: when you invest globally, you get to participate in growth stories that simply aren't available to you if you stay at home. So if you own a slice of the world's most influential companies, you benefit from innovation happening in places you might never visit. And that connects directly to one of the most important principles in investing, diversification, which is where we're going next. Now, you've probably heard the phrase, don't put all your eggs in one basket. In investing, that's not just a saying, it's one of the most important principles you can follow. Here's why. The value of investments can go up, but they can also go down. And if all your money is concentrated in one place, one company, one sector, or one country, when that has a bad year, your entire portfolio suffers. Diversification is the answer to that problem. By spreading your investments across different companies, sectors, and geographies, you reduce the impact of any single thing going wrong. If one part of your portfolio is struggling, the chances are that another part is holding up or even doing well. And this is where global investing and diversification naturally overlap, because investing globally isn't just about chasing growth in exciting markets, it's also a way of managing risk. If UK markets have a difficult period, exposure to US or Asian markets might cushion the blow. If the tech sector takes a hit, holdings in healthcare or consumer goods might steady the ship. Now, it's worth saying that not all global markets carry the same level of risk. Established markets, think the US, Europe, or Japan, tend to be more stable and predictable. Emerging markets, as I mentioned earlier, can offer higher growth potential, but they're also more volatile as they're more exposed to political instability, currency fluctuations, or changes in regulatory environments, which are all factors that can make emerging market investments move around more sharply. That's why many investors don't go all in one on one type of market. They mix it up, so they have a solid core of established markets with perhaps a smaller allocation to higher growth. higher risk markets on the side. As with all investing, there are no guarantees, but a well-diversified global portfolio gives you more levers to pull and more ways for your money to keep working, whatever the world throws at it. So we've covered the why. Now let's get to the part that often feels most daunting, the how. So how do you actually get your money into global markets? There are a few different routes, and they're not all equal in terms of simplicity, cost, or accessibility. The most direct option, but the one which generally carries the greatest risk, is buying individual shares in foreign companies. For major markets like the US or Europe, this is possible through most investment platforms, like Moneyfarm, of course. But beyond that, it gets complicated quickly. Access can be limited. There are often additional costs involved. Currency exchange adds another layer, and in some markets, there are tax implications to navigate too. And on top of all that, you've still got to decide what to buy, which, when your universe is the entire global stock market, is no small task. For most people, this is one reason why funds are the more practical answer. And as we've learned before, funds also provide the benefits of diversification, which is another important advantage of this type of investing. A fund bundles a collection of investments together, so you can buy them in one go, instead of buying single stocks, which can be affected by risks at the business level, such as management issues or operational faults. Funds allow for diversification across many businesses within the market or geography, so you can spread your bets across a wide range of organizations. And instead of researching and selecting individual companies yourself, you invest in the fund, and the fund does the heavy lifting for you. There are different types of funds, but the ones that have done most to open up global investing for everyday investors are ETFs, or exchange traded funds. Now, if you want to go deeper on how ETFs work, we have a dedicated video on the channel that you can find in the description. But the short version is this. Most ETFs are designed to track a market index, which means when you invest in one, you're effectively buying a tiny slice of every company in that index in one transaction. And for global investing, that's particularly powerful, as there are ETFs that track world indexes, which means that in one go, you can get exposure to both developed markets like North America, Europe and Japan, as well as emerging markets. ETFs also tend to be low cost, significantly cheaper than trading individual shares, and generally cheaper than most other types of funds too. And as we've talked about in other videos, keeping costs low matters, because every pound you're not paying in fees is a pound that stays invested and keeps working for you. The alternative to ETFs is an actively managed mutual fund. Now these work differently. Instead of tracking an index, they're run by a professional fund manager whose job is to pick investments and try to outperform the market. There are plenty of global mutual funds to choose from, with different focuses and strategies. The potential upside is that a skilled manager might beat the index. The trade-off is that they're more expensive and they don't always outperform, so it comes down to your preference and what you're comfortable with. Many investors don't choose one or the other. They use a combination, building a diversified portfolio that might include a broad global ETF as a core holding, while other funds layered on top to add specific regional or sector exposure. Now, a good thing to know is that as a UK investor, you can hold global investments in the stocks and shares ISA and benefit from tax breaks. With Moneyfarm, for example, you can build your own ISA portfolio by picking from more than 1,000 investments, including global ETFs and mutual funds. And you can also invest in the UK, US and European stocks. So there's no reason to miss out on those tax benefits just because you're investing beyond the UK. If you want to know more about how stocks and shares ISAs work, we've got a dedicated video on the channel, and the link is in the description. So there you have it. Global investing in a nutshell. I do hope you enjoyed this video, and if you did, please subscribe to the channel and check out the description to learn more about Moneyfarm. As always, I look forward to seeing you in the next video. Bye bye for now.